Hello my friends and welcome to this new episode of Money Talk. The topic of today's video is going to be about the Dotcom Bubble. Last time we talked extensively about bubbles in general, and today we will focus on one of the most famous examples of bubbles, the Dotcom Bubble. We will also have a look at one of the most iconic companies during the Dotcom Bubble, eToys. Let's dive in. Before getting started, please hit the subscribe button down there to never miss a new video and activate the notification bell to increase your financial literacy every single week. The Dotcom bubble took place in the United States and started somewhere in the early 1990s and bursted in 2000. As the name suggests, it mainly affected internet stocks, but also telecommunication stocks and other technological stocks. But it would be impossible to really understand this bubble if we did not talk about the circumstances in which it happened. You have to know that the 1990s was a period of euphoria in the United States and Western countries in general. The Cold War just ended and was won by the United States and Western countries. The consumer confidence skyrocketed. The economy was growing very fast. Unemployment was close to non-existent. Interest rates were very low. It means that borrowing money was very cheap. And best of all, we were seeing all those new amazing technologies appear. Those technologies were preparing us for a great, peaceful and brilliant millennium that was going to start in 2000. Life seemed so promising in the United States that people started having more babies. In retrospect, we talked about a second baby boom. And many foreigners also settled in the United States. So much so that in the 1990s, during the decade, the US population grew by more than 30 million. And many people thought that we were entering into a new era, the era of the new economy. The new economy would be made possible thanks to all this new technology that was appearing. Computers went from being these big, bulky machines only used by some nerd in big businesses to become an essential household appliance used by everybody. Mobile phones were becoming smaller and smaller and more affordable, and the internet was being widely adopted by the general public. Again, the internet was reserved for a niche market, but thanks to companies such as Netscape and Mosaic, it was made much more user-friendly and usable by the average Joe. All those new technologies were going to completely change the way we lived our lives and also change the way we did business. And you know what is the best of all? All those computer geeks such as Larry Ellison and Bill Gates were becoming millionaires. No, what am I saying? Billionaires with a B. Now that you grasped the atmosphere of the 1990s, imagine yourself. You're somewhere around 1993 and the internet is changing everything. It is creating one millionaire after the other. And there a smart investor wondered, why would we go through the hassle of making our own internet company when we can simply invest in internet startups? That was the beginning of the displacement stage of the bubble. At the very beginning of the bubble, all those technologies got the attention of all those investors and started pouring money into those technologies. And at that moment, the price of those stocks was very low and the economy was doing only one thing, going up, up and up. So that was a sound investment and there was absolutely no risk, right? And then from 1993 up until 1996, the Nasdaq gained more and more relevance and its price went up very sharply. And the Nasdaq is the stock index that represents technological stocks. It is the stock index that is made to represent the new economy. But up until the 1990s, it was a secondary index, always shadowed by its big brother, the S&P 500. But in the 1990s, the S&P 500, who cares? In the S&P 500, you have oil and gas companies, banks, car manufacturers. Who is going to need all of this in the new millennium, in 2000? But still, the Nasdaq was growing at a good pace. But it was still a reasonable investment, and most of the people pouring money into Nasdaq were professional investors, those who are at least supposed to know what they're doing. Most of the internet companies they were investing in had no real profits, and some of them didn't have any real revenue. But hey, they were promising, so it was worth the bet. And then, in 1996, the best year on the planet because it is when yours truly is born, well, something very important happened. The Telecommunications Act. This act was going to deregulate the telecom sector, and the telecommunication companies were going to be able to put optic fiber everywhere to provide internet to everybody. Great news! Let's buy more shares. In 1997, the beloved Clinton administration enacted the Taxpayer Relief Act that basically reduced the amount of taxes you had to pay when you were trading stocks. Hooray! Let's buy some more stocks. And that was the beginning of the Euphoria stage of the bubble. The Euphoria stage was really sweet. From 1996 up until early 2000, our famous index, the Nasdaq index, multiplied its price by 5. Imagine all the money you would have made if in just 4 years you had multiplied your investment by 5. At that moment, the media started being very interested about all those people who are making overnight fortunes trading dot-com stocks, and also about all those dot-com companies who are going to be the future of corporate America. And it is even said that some company at that time changed their company name and added the .com suffix just to rise their share price. And the general public wants to enjoy that party too. They are hit by the infamous FOMO, that is, fear of missing out. A lot of people, hundreds of thousands of people, suddenly become day traders. Even thousands of people have quit their 9-to-5 jobs to become full-time day traders. In the meantime, investment banks were also hit by FOMO, and they were wondering, how can we make money with dot-com companies? And the answer was very simple, doing IPOs. An IPO is when a company is taken public by selling their shares in the stock market. In normal times, it is very difficult to be eligible for an IPO. You need years and years of solid corporate profit, and you need to prove to everybody that you are going to increase your revenues significantly in the future with solid evidence. But during the dot-com bubble, none of that matters. If you're a dot-com company, you can do your IPO with none of this. Who cares about profits, ratios, revenues? All of that belongs to the old economy and should be forgotten. As a result, we see an explosion of the number of internet startup IPOs. All those internet startups that are not making a dime in profits, but making an IPO nonetheless. The people have confidence. They say, hey, those companies are going to make a lot of money in the future. It was very commonplace to see the share price of an internet startup double in its first day of trading. It is also a great state of euphoria in the offices of dot-com companies. They use all that money they got from investors to do lavish commercials. To give you an idea, in 1999, only 2 dot-com companies were doing commercials during the Super Bowl. In 2000, however, it was 17 dot-com companies doing commercials during the Super Bowl. For those of you who don't know it, the Super Bowl is the moment where the American football games take place. And a lot of people watch television, and making a commercial during that moment costs a lot of money. To give you an idea, in 2000, a 30-second commercial during the Super Bowl was worth $2 million. And the employees in the dot-com companies did have fun. The founders of the dot-com companies used a significant part of the investor money to throw parties, the infamous dot-com parties, with lavish food and drinks in the most expensive hotels. It was a full-blown bubble, but not everybody was blind to it. A few smart people saw that it was nothing more than another speculative bubble. Mark Cuban is an interesting example. When he saw the madness taking place, he sold all his dot-com stocks. And Sir John Templeton, another very famous investor, shorted dot-com stocks in the late 1990s. For your information, shorting a stock means that you're betting against the stock and you make money when the stock goes down. And finally, Alan Greenspan, the chairman of the Federal Reserve of the United States, called this bubble an irrational exuberance. But the vast majority of investors stayed in euphoria, And they didn't want to hear about all of this. Whenever they heard a skeptic, they said, no, he doesn't understand. He's too old to grasp the concept of the new economy. Ratios, earnings, profits, cash flows, none of that applies to us because we are the new economy. The Uncle Sam, that is the US government, knew about this bubble, but they did nothing because they were scared about another potential danger, the year 2000 problem. It may sound ridiculous nowadays, but back then there was a palpable fear that on January 1st, 2000, all electronic equipment on planet Earth would fail. The reason being that the year 2000 in computer coding is 00, and that would cause everything to collapse. The year 2000 came by, and hopefully nothing happened. The doomsday scenario was wrong. One of the main reasons why is that the computer companies sold a massive amount of updates and made a lot of money at the same time. And now the 90s were over. The 90s were a paradise for everybody, and especially for the dot-com bubbles. But now the 2000s were going to be very bad, especially for the dot-com companies. In 2000, seeing that the year 2000 problem was not a problem anymore, the Federal Reserve raised the interest rates very aggressively. That was a very bad thing for the dot-com companies because they had a lot of debt, and if the interest rate went up, they had to pay much more for all of that debt. Plus, when the interest rate goes up, investors tend to become much more conservative, and they remove that money from risky ventures to much more conservative and safe assets, such as bonds and normal shares. In March 2000, the Nasdaq index reached its peak at 5,048 points, and only 3 days later, Japan announced that it was entering into a recession. And even though it seems completely unrelated to dot-com stocks, that was enough to cause fear among investors who decided to drop completely risky and speculative stocks in favor of much more conservative assets. Worst of all, the media that was fueling the bubble so badly suddenly changed its tone and started predicting bankruptcies among dot-com companies. As we can see in this article from Barron's magazine, it says, "Birding up, warning, internet companies are running out of cash fast." The 90s were a paradise, but the 2000s were hell on earth. All the events, one after the other, were negative. Terror attacks, accounting scandals, trials against Microsoft, etc. That shaked so much investor confidence that nobody wanted to buy dot-com stocks anymore. In 2002, the Nasdaq had shed 78% of its value compared to early 2000, its lowest point since 1996. $5 trillion had completely vanished, and it took 15 years for the Nasdaq to recover and reach back its level of early 2000. Just like all other bubbles in the past, just a handful of investors made money. All the rest lost everything. The majority of dot-com companies went bankrupt and many people lost their jobs. It was the end of the dot-com bubble. But the story of the dot-com bubble would not be complete if I didn't tell you the story of one of the most iconic dot-com companies, eToys. In 1997, a corporate vice president at Disney announced to his boss that he was quitting. He wanted to create his own company, his own dot-com company. And that's what he did. Shortly after, he created the eToys company in a startup studio called Idea Lab in Pasadena. That still exists, by the way. The business model of eToys was very simple. Why would you go to a traditional toy store with packed parking lots, long waiting queues, kids screaming and crying everywhere, when you can simply buy a toy from the internet with your computer by a simple click and have the toy delivered at your house? eToys wanted to become the Amazon for toys, and it sounded great on paper. And eToys didn't think very fondly of brick and mortar shops like Walmart or Toys R Us. They represented the old economy, and it didn't make sense anymore to go there, like this commercial very subtly suggests.
Shopping for toys shouldn't be a battle. eToys.com lets you shop online for thousands of toys. eToys.com. We bring the toy store to you.
I love the smell of Play-Doh in the morning.
And everybody agreed with that business model. Investors enthusiastically poured money into eToys. So eToys created their website and started operations. The company was still losing money because they were spending very heavily to acquire new customers. But despite the losses and the young age of the company, eToys made its IPO in 1999, only 2 years after being created. Oh boy, what a trading day! The first day of trading of eToys was crazy. The stock price went from $20 to $76 in the first day of trading. And then the Christmas period approached, a very important period for all toy retailers. And there again, eToys made it. They made an incredible amount of sales, much more than what was expected. And the only serious competitor they had at the time, Toys R Us, completely flopped. The people at eToys were ecstatic. They were expecting $210 million worth of sales in the Christmas of the year 2000. And yes, the company was still making losses, but if they made $210 million in sales, they would break even and make profit. But just like all the other dot-com companies, the 2000s were going to give only bad news. In Christmas of the year 2000, only $107 million of sales were made versus 210 they had projected. The losses were massive, and Toys R Us had formed an alliance with Amazon to sell toys online, which depressed the earnings even more. At that moment, investors completely lost confidence in eToys. eToys begged for more funding, but at that moment, the dot-com bubble had already bursted, and investors didn't want to hear about dot-com companies anymore. In March of 2001, eToys filed for bankruptcy. eToys had become yet another victim of the dot-com bubble. Their iconic website was shut down, and still today we can see the empty website with this text, "We'll be right back." But nobody will ever come again. That's it for this video about the dot-com bubble and eToys. As always, I hope you enjoyed this video and learned something from it. If there is a topic you want me to cover in a future video, please shoot me an email to the address that is in the description below, and I will see you very soon for the next video. In the meantime, take care.